The credit industry plays a pivotal role in the global economy. When lenders and investors provide capital to borrowers, be they individuals, small businesses, governments, or large corporations, real-world economic activities are supported. Things like building roads and bridges and creating jobs and funding innovation. But for that to happen, lenders and investors need to accurately assess the credit risk involved. In other words, how likely is it that they'll be paid back? Now, one of the largest forms of credit in the global economy is bonds, instruments used by corporates and governments to borrow from investors. With the bond market accounting for trillions of dollars in outstanding debt, the ability to manage credit risk is at the heart of the financial services industry. The financial crisis revolutionized the way lenders and investors assess, manage, and report credit risk. Regulators have increased the cost of getting it wrong. Investors want more diligence before taking those risks. These events, to a large part, have driven the adoption of technology in credit risk management, making it easier, faster, and more transparent. Over the past few years, we've seen an explosion of new technologies that help lenders do that. They range from analyzing the value of commercial real estate using alternative data sources like GeoPhy to machine learning solutions that analyze the covenants of high-yield bonds, to artificial intelligence-based tools for assessing environmental, social, and governance scores for borrowers, like True Value does, to name a few examples. Now, let's take a look at why these tools and technologies are so important. First, the financial crisis caused regulators to demand greater transparency, management, and control of credit risk by banks. New rules and accounting standards not only require higher levels of sophistication from financial institutions, but aggressively penalize non-compliance, potentially raising costs and impacting profitability. Penalties have totaled more than $200 billion since the crisis. Therefore, banks had to undertake increasingly sophisticated credit risk analysis, portfolio management, and stress testing under different scenarios. This created a need for more data and better insights to help satisfy regulators' demands and keep the compliance costs down. Post-crisis regulation also created an impetus to digitize the trading of credit-based securities. Traditionally, a large portion of credit-based instruments, especially the more sophisticated ones, traded over the counter through phone calls and emails. Now, these instruments were considered too complex and illiquid to be traded in an electronic marketplace that allows buyers and sellers to find their counterparties. But due to regulation, we've seen an explosion of innovative platforms that help these complex instruments trade in a transparent manner. This has rapidly reduced information asymmetry and improved pricing transparency in the markets. Second, rising compliance costs reduce the profitability of loans, another form of credit provided by banks or lenders to borrowers. When lenders' margins are compressed, the ability to manage credit risk becomes the single biggest driver of profitability, since an increase in defaults can completely wipe out profits. This is especially true for smaller sized loans, where assessing credit risk can be challenging due to unreliable data. However, advances in digitization are enabling easy access to several alternate data sources that provide insights into credit risk. For example, companies like Cortera now provide insight into small business payment. Others provide insight into their payment behaviors like utility loans, loan payments, or taxes. Litigation databases give instant access to management liabilities. And advances in AI can mine textual data sources like news and legal filings to develop risk signals. In all of these cases, innovation in accessing data sets is making credit analysis easier and more robust. Lastly, the lending landscape has become more competitive. Alternative lenders like private equity funds and insurers are now major providers of credit, in addition to banks. And new technologies have enabled innovative lending sources like peer-to-peer to emerge. While peer-to-peer loans don't have a long performance history, the capital markets have shown some acceptance by securitizing them for trading in the marketplace. While there is no doubt that this new type of credit will go through its own credit cycle of ups and downs, it will clearly play a role in the long term, and investors will need to be properly educated on the risks it entails. Providers like PeerIQ can help them do that. Lenders and investors of all stripes rely on key pieces of information about their borrowers to guide their lending and investing activities. When they need insight into credit assets, alternative data sources, analytics, and artificial intelligence are increasing their options. Across the spectrum, there are more tools than ever before to make credit analysis faster, more efficient, and more transparent. All qualities that contribute to efficient, well-run capital markets and robust economies. And that's how the power of fintech is transforming credit risk management.